There are moments in financial history when the difference between what people think they own and what they actually control becomes painfully clear. We are approaching one of those moments now. The choice between holding physical gold in your hands or owning shares in an exchange-traded fund might seem like a minor detail, a question of convenience rather than strategy. But that assumption could cost you everything when the system comes under stress. Most people never stop to ask what they truly possess when they buy a gold ETF. They see the ticker symbol, they watch the price move in lockstep with the metal, and they assume they have exposure to gold. But exposure is not the same as ownership, and ownership is not the same as control. When the next crisis hits, and it will hit, that distinction will matter more than almost anything else in your portfolio.
If this kind of clarity helps you see beyond the surface of what everyone else accepts, without question, subscribe now and join
us for the analyses and alerts that cut through the noise. Let me start with a principle that applies across all of finance. The more layers of intermediation between you and an asset, the more points of failure exist. Every promise, every contract, every custodian, every legal structure adds another link in a chain. And chains break. They break under stress. They break when liquidity vanishes. They break when institutions face pressures they cannot withstand. Physical gold has no such chain. It sits in your possession or in a vault you control directly. There is no counterparty. There is no promise that someone else will honor. There is just the metal itself, inert and unchanging, waiting for the world to recognize its value again. An ETF, by contrast, is a financial instrument. It is a claim on gold, not gold itself. That claim is backed by institutions, by custodians, by legal agreements, by the assumption that the system will continue to function as it has. When you buy shares in a gold ETF, you are buying into that system. You are betting that the fund will hold the gold it says it holds, that the custodian will safeguard it, that redemption mechanisms will work, that liquidity will be there when you need it, and that no regulatory change will suddenly alter the terms under which you operate. These are not paranoid concerns. They are structural realities. And history shows us that when systems come under enough pressure, structural realities change overnight. Consider what happened during past crises. In 2008, when liquidity dried up and institutions scrambled for cash, the spreads between paper gold and physical gold widened dramatically. People who thought they had seamless access to the metal discovered that converting their paper claims into actual bars or coins was either impossible or prohibitively expensive. The market for physical delivery became dislocated from the price on the screen. Those who held the metal itself were insulated. Those who held paper were exposed. That was not a theoretical risk. It was a lived experience for thousands of investors who learned the difference the hard way. Now think about the environment we are in today. Debt levels have never been higher. Central banks have expanded their balance sheets to sizes that were unimaginable a generation ago. Currencies are being debased steadily, not through dramatic collapses, but through persistent inflation that erodes purchasing power year after year. Trust in institutions is weakening. Geopolitical tensions are rising. Supply chains remain fragile, and the financial system, despite its appearance of stability, is stretched thin by leverage, by interconnectedness, by the sheer complexity of the instruments that underpin it. In such an environment, the question is not whether stress will come, it is when and how severe it will be. When that stress arrives, the weaknesses in paper gold will be exposed. Redemption mechanisms that work smoothly in calm markets will fail in chaos. Custodians who seem reliable today may face pressures tomorrow that force them to make choices that are not in your interest. Regulatory authorities, when faced with systemic risk, will act to protect the system, not to protect individual investors. They will freeze assets, impose controls, change rules, and redefine what ownership means. If you think that sounds extreme, look at history. Gold confiscation in 1933 did not happen because of a sudden whim. It happened because the government faced a crisis and decided that private ownership of monetary gold was incompatible with the policies they needed to implement. The mechanism was already in place. The legal authority existed, and when the moment came, it was used without hesitation. ETFs, despite their popularity and despite the convenience they offer, carry a version of that same risk. They are embedded in the regulated financial system. They operate under rules that can be changed. They depend on institutions that can be pressured. And they offer liquidity only as long as the market allows it. When liquidity vanishes, when redemptions are halted, when custodians face insolvency or regulatory constraints, the promise that your ETF shares represent real gold becomes a question mark. You might still own the shares, but accessing the metal, converting those shares into something tangible, something you can hold, becomes a problem that has no easy solution. Physical gold, on the other hand, removes you from that system. It gives you control. It eliminates counterparty risk. It does not depend on custodians, regulators, or the smooth functioning of financial markets. When you hold physical gold, you hold an asset that has been recognized as valuable for thousands of years across every civilization, every currency regime, every political system. That continuity is not an accident. It reflects something fundamental about human nature and about the role of tangible wealth in times of uncertainty. Gold is not someone's liability. It is not a promise to pay. It is the thing itself. And that distinction becomes critical when promises start to break down. Recuerde que este contenido es educativo y no constituye asesoramiento financiero. Su objetivo es ayudarte a pensar con mayor claridad sobre tus decisiones. Let me walk you through the mechanics of how an ETF actually works, because understanding the structure reveals the vulnerabilities. When you buy shares in a gold ETF, you are buying a fractional claim on a pool of gold bars held by a custodian. The fund manager does not own the gold directly. The custodian holds it, often in a vault in London or New York or another major financial center. The bars are allocated, meaning they are supposedly identifiable and segregated, but you, as a shareholder, do not have a direct claim on any specific bar. You have a claim on the fund, and the fund has a claim on the custodian. That is 2 layers of intermediation right there. Now add in the possibility that the custodian itself is part of a larger financial institution that has other obligations, other exposures, other risks. What happens to your claim if that institution faces a crisis? The answer depends on legal structures, on bankruptcy proceedings, on regulatory decisions, on factors that are entirely outside your control. You might win eventually, you might get compensated, but in the moment when you need access to your wealth, when markets are in turmoil and uncertainty is peaking, you are stuck waiting for a resolution that could take months or years. Meanwhile, those who hold physical gold can act immediately. They can transact, they can move, they can preserve their wealth without waiting for anyone's permission. There is also the question of premiums and discounts. ETFs trade on exchanges, and their price is supposed to track the spot price of gold. But in practice, especially during periods of stress, that tracking breaks down. The fund can trade at a premium when demand for shares exceeds the ability of authorized participants to create new shares quickly, or it can trade at a discount when redemptions surge and liquidity dries up. Either way, you are at the mercy of market dynamics that have nothing to do with the underlying value of the gold itself. Physical gold, by contrast, has no such distortion. Its value is its value. There is no gap between what it is and what it trades for, because you are not trading it in a financial market. You are holding it. Another layer of risk comes from the regulatory environment. ETFs are securities. They are subject to securities laws, to exchange rules, to regulatory oversight. That oversight can change. In times of crisis, governments have a long history of imposing capital controls, restricting asset movements, freezing accounts, or changing the rules around ownership and redemption. If an ETF is deemed a threat to financial stability, or if holding gold is deemed incompatible with policy objectives, the government has the legal authority to intervene. They can halt trading, they can freeze redemptions, they can impose taxes or levies, they can even confiscate the underlying assets if the legal framework allows it. You might think that is far-fetched, but it is not. It has happened before in different forms, and the legal mechanisms to do it again are already in place. Physical gold held outside the banking system is far harder to control. It is private, it is portable, it does not show up on financial statements or regulatory filings, it is not tied to any institution or any system that can be easily pressured. That is why throughout history, in every period of monetary chaos, people have turned to physical gold, not because it is convenient, but because it is beyond the reach of systems that fail. It is the ultimate insurance against the breakdown of trust. Now, let me address the arguments that are often made in favor of ETFs, because they are not without merit. The convenience is real. You can buy and sell shares instantly. You do not have to worry about storage, about security, about insurance, about the logistical challenges of moving physical metal. You can hold gold in a retirement account. You can trade it alongside your other securities. For many people, especially those who are not expecting a systemic crisis, those advantages outweigh the risks. And in normal times, that calculation might be reasonable. But we are not in normal times. The signs of systemic stress are everywhere, and betting that the system will hold together indefinitely is a gamble that more and more people are beginning to question. There is also the argument that ETFs are more liquid, and in a narrow sense, that is true. You can sell your shares in seconds, but liquidity is only valuable if it works when you need it. And the times when you most need liquidity are precisely the times when it tends to disappear. In a crisis, when everyone is trying to exit at once, liquidity vanishes. Bid-ask spreads widen. Trading halts. Markets freeze. The ETF that seemed so liquid yesterday becomes a trap today. Physical gold, meanwhile, does not depend on market liquidity. It is always valuable. It is always accepted. It might take longer to transact, but the transaction will happen, and it will happen on terms that reflect the real value of the metal, not the dysfunction of a market in panic. The deeper issue here is psychological. Owning physical gold changes the way you think about wealth. When you hold it, you feel its weight. You see its permanence. You understand that it is not just another number on a screen. It is real. That connection to tangibility matters more than most people realize. It grounds you. It gives you confidence in moments when everything else seems uncertain. It reminds you that not all wealth is ephemeral. Not all value is subject to the whims of policymakers or the fluctuations of sentiment. There is something irreducible about holding gold in your hand, something that cannot be replicated by watching a ticker move on a screen. ETFs, by their nature, keep you at a distance from that reality. They abstract gold into a financial product. into something that feels more like a stock than a piece of timeless wealth. And that abstraction makes it easier to treat gold like any other trade, to buy and sell based on short-term movements, to lose sight of why you owned it in the first place. Physical gold, because it is harder to buy, harder to store, and harder to sell, forces you to think differently. It forces you to commit. And that commitment, that long-term perspective, is often what separates those who preserve wealth through crises from those who lose it chasing short-term opportunities. Let me be clear about something. I am not saying that ETFs have no place in a portfolio. For certain purposes, for certain time frames, for certain investors, they can serve a role. If you are looking for short-term exposure to gold as a trade, if you are managing a portfolio where convenience and liquidity matter more than control, if you are operating in an environment where you believe systemic risk is low, then an ETF might make sense. But if you are thinking about gold as insurance, as a hedge against the breakdown of the monetary system, as a store of value that will endure when other assets fail, then physical gold is the only answer. The risks inherent in paper gold, the layers of intermediation, the dependence on institutions, the regulatory vulnerabilities, all of those risks undermine the very purpose that gold is supposed to serve. The current environment makes this choice even more stark. We are in the late stages of a long-term debt cycle. The imbalances that have been building for decades are becoming unsustainable. Central banks are trapped between the need to control inflation and the need to support over-leveraged economies. Geopolitical fractures are widening. The global monetary order that has held since the end of World War II is under strain. In such a moment, the idea that the system will continue to function smoothly, that institutions will honor their obligations, that liquidity will always be there, is an assumption that deserves to be questioned. And if you question it, if you look honestly at the risks, the case for physical gold becomes overwhelming. Think about what happens in a scenario where the dollar loses its reserve status, where inflation spirals out of control, where a major financial institution collapses and takes others with it, where governments impose capital controls or freeze assets to prevent capital flight. In any of those scenarios, the value of gold will rise. But the question is, will you be able to access that value? If your gold is held in an ETF, the answer is uncertain. If your gold is held physically, the answer is yes. That certainty, that control, is worth far more than the convenience of clicking a button to buy or sell shares. There is also the matter of allocation. Even if you decide to hold some gold through ETFs for reasons of convenience or liquidity, it should not be your only exposure. A balanced approach would include a significant allocation to physical gold, held in a secure location that you control, or that is held by a custodian with a strong reputation and legal structure that protects your direct ownership. The physical gold serves as the foundation, the insurance policy, the asset that you know will be there no matter what. The ETF can serve as the tactical component, the part of your portfolio that you can adjust quickly if market conditions change. But the foundation has to be solid. Without physical gold, your exposure to this critical asset is built on a premise that could crumble when you need it most. Another dimension to consider is the difference in how these assets are treated legally. Physical gold, especially when held in certain forms like collectible or numismatic coins, may enjoy protections under the law that standard bullion does not. It may be exempt from certain types of confiscation or regulation. ETFs offer no such protections. They are financial securities, subject to all the rules and risks that apply to securities. If a government decides that ownership of gold ETFs is incompatible with monetary policy, they can restrict or prohibit it with a stroke of a pen. Physical gold especially when held privately and discreetly, is far harder to regulate, far harder to confiscate, far harder to control. History has shown us repeatedly that in times of crisis, governments act to protect themselves, not to protect individual property rights. They will do what they believe is necessary to stabilize the system, even if that means overriding legal protections or redefining ownership. The precedent is clear, the mechanisms are in place, and the willingness to use those mechanisms will emerge the moment the crisis becomes severe enough. Betting that it will not happen or that it will not happen to you is a form of complacency that could prove costly. The choice between physical gold and ETFs is not just about gold. It is about how you think about risk, about control, about the assumptions you are willing to make about the future. It is about whether you believe the system is fundamentally stable or fundamentally fragile. It is about whether you trust institutions to honor their promises or whether you prefer to eliminate the need for that trust altogether. These are not easy questions, and the answers will be different for different people. But they are questions that deserve serious thought, especially now when the signs of systemic stress are becoming harder to ignore. In the end, the value of gold is not just in its price. It is in what it represents: security, permanence, independence, a hedge against the failure of systems built on promises and trust. Physical gold embodies those qualities in a way that paper gold cannot. It is the difference between owning something and owning a claim on something. It is the difference between control and dependence. And in a world where dependence on failing systems is becoming more dangerous by the day, that difference is everything. So when you think about your allocation to gold, ask yourself what you are really trying to achieve. If the answer is convenience, liquidity, and the ability to trade in and out quickly, then ETFs might serve that purpose. But if the answer is protection, security, and the preservation of wealth through whatever comes next, then physical gold is the only choice that makes sense. The world does not wait for you to figure this out. The cycles proceed whether you are ready or not. And when the next crisis comes, when the system reveals its fragility, the people who chose control over convenience, who chose tangible wealth over paper promises, will be the ones who endure. The rest will be left wondering why they trusted a system that was never designed to protect them in the first place. Now, let me take you deeper into the mechanics of what actually happens during a redemption crisis, because this is where theory meets reality and where the assumptions about ETF safety fall apart. When markets are calm, the creation and redemption mechanism of an ETF works beautifully. Authorized participants, typically large financial institutions, can create new shares by delivering physical gold to the fund, or they can redeem shares by taking physical gold out. This process is supposed to keep the ETF price in line with the spot price of gold. But this mechanism depends entirely on the willingness and ability of these authorized participants to act. And in a crisis, that willingness and ability can evaporate. Imagine a scenario where global markets are in free fall. Credit markets are seizing up. Banks are facing liquidity pressures. Counterparty risk is spiking. In such an environment, the large institutions that serve as authorized participants have their own survival to worry about. They are not going to tie up capital in arbitrage trades involving gold ETFs. They are not going to take on the risk of holding physical gold during transport. They are not going to commit resources to activities that do not directly support their balance sheets. When that happens, the creation and redemption mechanism breaks. The ETF price can diverge wildly from the spot price. And you, as a shareholder, are stuck holding a security that no longer reflects the value of the underlying asset. This is not speculation. We have seen versions of this play out in other markets. During the March 2020 panic, certain bond ETFs traded at massive discounts to their net asset values because the redemption mechanism failed. Market makers stepped back. Liquidity dried up. Prices became dislocated. The Federal Reserve had to intervene directly to stabilize those markets. Now, imagine the same thing happening with gold ETFs, but in a crisis where the Federal Reserve is part of the problem, where central banks are losing credibility, where the very institutions that would normally step in are themselves under stress. Who rescues the ETF market then? The answer is no one. And the people holding ETF shares find themselves trapped in a vehicle that has lost its connection to the asset it is supposed to represent. Physical gold has no such mechanism to break. There is no authorized participant. There is no creation or redemption process. There is no need for liquidity providers or market makers. The gold simply exists. Its value is determined by what people are willing to pay for it in direct transactions. And in a crisis, when trust in financial institutions is gone, when paper assets are suspect, physical gold becomes the most liquid asset of all because everyone recognizes it and everyone wants it. The paradox is that the asset, which seems less liquid in normal times, becomes more liquid in the times that matter most. Let me also address the tax considerations, because they are often cited as a reason to prefer ETFs. In the United States, physical gold is taxed as a collectible, meaning long-term capital gains are taxed at a maximum rate of 28% rather than the preferential 15 or 20% rate that applies to most securities. ETFs, depending on their structure, may qualify for more favorable tax treatment. On the surface, this seems like a point in favor of ETFs. But think about what you are optimizing for. You are optimizing for a few percentage points of tax savings in a scenario where the system continues to function, where you sell at a profit, where the government honors its tax code, and where the difference in tax rates actually matters. Now compare that to the scenario where the system does not function, where your ETF shares are frozen or devalued, where you cannot access your wealth at all. In that scenario, the tax advantage is meaningless. You saved on taxes but lost your wealth. That is not a trade worth making. Moreover, the tax treatment of physical gold can change. Governments facing fiscal crises often look for new sources of revenue, and wealth held in physical form is an obvious target. But at least with physical gold, you have options. You can choose when to sell. You can choose how to structure the transaction. You can even choose not to sell at all and simply hold the metal as a store of value outside the financial system. With an ETF, you are locked in to the tax and regulatory framework of the securities market. You have no flexibility. You are subject to whatever rules the government decides to impose, and those rules can change overnight. There is also a psychological dimension to taxation that is often overlooked. The knowledge that you will owe a higher tax rate on gains from physical gold can actually be a benefit because it discourages you from selling prematurely. It encourages a long-term hold mentality. It reinforces the idea that gold is not something you trade in and out of, but something you accumulate and preserve. ETFs, with their lower tax rates and ease of trading, encourage the opposite behavior. They make it easy to treat gold as just another position in your portfolio, something you adjust based on short-term market views. And that mindset is exactly what undermines the purpose of owning gold in the first place. Now let me turn to the issue of storage, because this is where many people get tripped up. They look at the cost and complexity of storing physical gold and conclude that ETFs are the better option. But storage is not a cost. It is an investment in security. When you store physical gold properly, whether in a safe at home, in a safety deposit box, or in a private vault facility, you are paying for control. You are paying for the assurance that your wealth is not dependent on the solvency of a financial institution or the goodwill of a government. That assurance is priceless in a crisis. Yes, storage has costs. You might pay a few $100s a year for a safety deposit box or a percentage fee for professional vault storage, but compare that to the risks you are taking with an ETF. You are exposed to custodian risk, to regulatory risk, to liquidity risk, to redemption risk, to all the layers of complexity that come with a financial product. And for what? To save a few hundred or even a few $1,000s a year? That is a false economy. You are saving pennies while exposing yourself to the risk of losing everything. Moreover, the storage of physical gold gives you options that ETFs do not. You can store it in multiple locations to reduce concentration risk. You can store it in different jurisdictions to protect against political risk. You can store some at home for immediate access and some in a vault for long-term security. You can structure your storage in ways that maximize privacy and minimize vulnerability. With an ETF, you have none of these options. Your gold is wherever the custodian decides to keep it, and you have no say in the matter. Let me also talk about the issue of insurance, because it is closely related to storage. Physical gold can be insured, and reputable storage facilities include insurance as part of their service. But even if you choose not to insure your physical gold, you are making a conscious trade-off. You are accepting the risk of theft or loss in exchange for lower costs and greater privacy. That is a risk you can evaluate and manage. With an ETF, you are also exposed to risk, but it is not a risk you chose or even fully understand. It is the risk that the custodian's insurance is inadequate, that legal protections fail, that the fund structure itself has vulnerabilities. These are risks that are hidden in the fine print, risks that only become apparent when it is too late to do anything about them. The question of where to store physical gold is important, and the answer depends on your circumstances. If you expect to need access to your gold quickly, storing some at home or in a local safety deposit box makes sense. If you are holding gold for long-term wealth preservation, storing it in a secure vault facility in a stable jurisdiction is prudent. The key is to think through the scenarios that worry you most and structure your storage accordingly. If you are worried about government confiscation, storing gold outside your home country might be wise. If you are worried about social unrest, having some gold at home for immediate access could be critical. If you are worried about both, a diversified storage strategy that includes multiple locations and multiple jurisdictions is the answer. ETFs offer none of this flexibility. They offer a one-size-fits-all solution that assumes the world will continue to work as it does today. And that assumption, as we have seen throughout history, is the assumption that fails when you need it most. Physical gold, by contrast, allows you to tailor your holdings to your specific concerns and your specific circumstances. It allows you to take control rather than delegating that control to institutions that may not have your best interest at heart. Now, let me address one more argument in favor of ETFs, which is the argument of scale. Some people say that if you are holding a large amount of gold, tens of millions of dollars or more, the logistics of physical ownership become prohibitive. The storage costs rise. The security concerns multiply. The complexity increases, and therefore ETFs become the practical solution for large holders. But this argument, while superficially plausible, misses the point. If you are holding tens of millions of dollars in gold, you are doing so because you are worried about systemic risk. You are worried about scenarios where financial institutions fail, where currencies collapse, where the normal rules of the game no longer apply. In those scenarios, the very institutions that make ETFs convenient are the ones that will fail you. The custodians, the authorized participants, the regulators, all of them are part of the system you are trying to protect yourself against. Relying on them to safeguard your wealth in a crisis is self-defeating. Large holders of gold have options that smaller holders do not. They can hire private security. They can use specialized vault facilities with the highest levels of protection. They can diversify across multiple jurisdictions and multiple storage providers. They can structure their holdings in ways that maximize both security and accessibility. Yes, these options come with costs, but the costs are trivial compared to the value being protected. And more importantly, these options provide real security, not the illusion of security that comes from owning shares in an ETF. The truth is that the wealthiest and most sophisticated investors in the world, the ones who have the most to lose and the most resources to protect it, overwhelmingly prefer physical gold over ETFs. They understand the risks, they understand the trade-offs, and they choose control over convenience every time. If you are managing family wealth that needs to endure for generations, you do not take shortcuts. You do not accept counterparty risk. You do not rely on institutions that could fail. You hold the real thing, and you structure your ownership in ways that maximize resilience. That is the lesson that smaller investors should learn from the behavior of the ultra-wealthy. Let me now turn to the question of timing, because some people argue that even if physical gold is superior in a crisis, ETFs are fine for now and you can always switch later if things get bad. This is one of the most dangerous assumptions you could make. The time to switch from paper gold to physical gold is not when the crisis is obvious. It is before the crisis becomes obvious. Because once the crisis is underway, the mechanisms that allow you to convert paper into physical will be the first to break. Premiums on physical gold will skyrocket. Delivery times will stretch from days to weeks to months. Dealers will run out of inventory, and you will find yourself stuck holding paper that you cannot convert into the real thing at any reasonable price. This has happened before. In 2008, as the financial crisis intensified, premiums on physical gold coins and bars surged to 20, 30, even 40% above the spot price. People who wanted to buy physical gold found that it was either unavailable or prohibitively expensive. Meanwhile, the ETFs continued to trade at or near spot, creating the illusion that access to gold was still easy. But that illusion was just that, an illusion. The people who held physical gold before the crisis were protected. The people who tried to buy during the crisis paid a massive premium or could not buy at all. And the people who held ETFs found that converting their shares into physical metal was either impossible or so expensive that it negated any supposed gains. The lesson is clear. If you believe that physical gold is the superior choice in a crisis, then you need to own it before the crisis, not during it. Waiting until the warning signs are obvious means you have waited too long. The time to act is when the risks are building but not yet recognized by the majority. That is, when premiums are low, when supply is abundant, when the transition from paper to physical can be made on favorable terms. Once everyone else figures it out, the opportunity is gone. There is also a behavioral aspect to this. Owning physical gold requires a decision, an action, a commitment. It is harder than clicking a button to buy an ETF. And that friction, that difficulty, is actually a feature, not a bug. It forces you to think seriously about what you are doing. It forces you to confront the possibility of crisis in a tangible way. And once you have made that commitment, once you have taken delivery of the metal and stored it securely, you are far less likely to panic and sell at the wrong time. Physical gold, by its very nature, encourages the kind of long-term, disciplined thinking that is essential for preserving wealth through turbulent times. ETFs, by contrast, make it too easy to buy and too easy to sell. They encourage reactivity. They encourage you to treat gold as just another asset to be traded based on news and sentiment. And that behavior is exactly what destroys wealth in volatile markets. The people who preserve wealth are the ones who make decisions based on principles, who commit to positions based on long-term analysis, and who have the discipline to hold through short-term volatility. Physical gold, by making transactions more difficult, naturally encourages that discipline. ETFs, by making transactions effortless, naturally undermine it. So when you think about the choice between physical gold and ETFs, do not just think about the mechanics. Think about the psychology. Think about how the structure of the asset will influence your behavior. Think about whether you want to own something that encourages trading or something that encourages holding. Think about whether you want convenience or control. And think about what kind of investor you want to be. Do you want to be someone who reacts to markets, who chases trends, who relies on institutions to protect you? Or do you want to be someone who thinks independently, who takes control of your own wealth, who prepares for scenarios that others refuse to consider? The choice of asset, physical versus paper, is also a choice of identity. Let me conclude by addressing the ultimate question, which is what percentage of your gold holdings should be physical versus ETFs? And the answer for most serious investors is that the vast majority should be physical. If you are holding gold as insurance, as a hedge against systemic risk, as a store of value for the long term, then there is no substitute for physical ownership. The ETF can serve as a small tactical position, something you use for short-term trades or for liquidity management. But it should never be the foundation. The foundation must be real, tangible, controlled by you. A reasonable allocation might be 80 or 90% physical and 10 or 20% in ETFs, or even 100% physical if you are truly concerned about systemic risk and willing to accept the reduced liquidity. The exact numbers depend on your situation, your risk tolerance, your access to storage, and your views on the probability of crisis. But the principle is clear. Physical gold should be the core holding, the asset you count on when everything else fails. ETFs, if you use them at all, should be the peripheral holding, the asset you use for convenience, but never rely on for survival. In closing, the choice between physical gold and ETFs is one of the most important decisions you will make in structuring your wealth for an uncertain future. It is a choice between reality and representation, between control and convenience, between independence and dependence. The world is entering a period of profound instability, a period where the assumptions that have held for decades are being tested, where the institutions that seem permanent are revealing their fragility, where the rules are changing in ways that will catch most people off guard. In such a world, the people who survive and thrive are the ones who prepare in advance, who take control of their own destiny, who refuse to delegate their security to systems that were never designed to protect them. Physical gold is the tool for that preparation. It is the asset that endures when others fail. It is the choice that separates those who understand what is coming from those who will be blindsided by it. Make your choice wisely, make it soon, and make it with the full understanding of what is at stake. The clock is ticking, and the window for action is closing faster than most people realize.